Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Stephanie Roth of Wolfe Research anticipated 175,000 jobs were added last month, and for unemployment to come in line at 4.2%. Stephanie, I'm pleased to say, is back with us. Stephanie, first of all, welcome back. Second of all, congratulations on your little baby girl. We're looking forward to more conversations with you in the future. So thanks for racing back for Payrolls Friday. We appreciate it. Let's talk about payrolls first, Stephanie. Let's get to it. Payrolls on Friday, the median estimate in our survey around 165,000. We've already heard from the Fed chair, Chairman Powell in Jackson Hole, that he does not welcome any further deterioration in this jobs market. What is further calling further deterioration in this jobs market? How would we define that on Friday?
I think that would be another payrolls print that's sub 150,000. I think that would be the unemployment rate potentially rising up to 4.4%. Again, not our call, but if we continue to just see more signs of softness, our base case is that a lot of the softness that we saw in the month of July was driven by Hurricane Beryl. And we'll see a 37,000 rebound from the state of Texas, in which case our payrolls print will be above 150,000, which we kind of view as trend. So if we see a number closer to 100,000 this month, and we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
Even if we get 150, given the revisions we saw over the previous year, why shouldn't I just chop off 60, 70,000 off that number on Friday?
Well, I think the revisions might be a little bit overstated, right? So we initially had the numbers that came in, and then it was revised down because of unemployment insurance records. And it's actually possible the revisions won't be quite as large once we get the final numbers, because immigration has been playing a role here, and it's possible that's not necessarily getting counted in the unemployment insurance. So basically, it's a lot of noise to say, I wouldn't necessarily chop off 60 to 70,000. Maybe you can chop off 30 to 40,000, but then you're still looking at a labor market that's still growing jobs and an economy that's doing okay. And by the way, consumer spending is growing about 3% in real terms.
Slowing, so not slow. I'd also love to get your take on what happened yesterday with the ISM manufacturing. We just had Andrew Hollenhorst publish a report saying a fifth consecutive sub-50 ISM reading shows the manufacturing sector is in a sustained contraction. Do you foresee that through the end of the year?
The ISM has been weak for a long time. It hasn't been a great measure of what's happening in terms of the broad economy. And by the way, measures of sentiment, which is effectively what a PMI is, it's asking, purchasing managers, how are conditions this month versus last month. Same with consumer confidence. That would have told you we were in a recession for all of last year. So I wouldn't necessarily take that as an indication of where actual broad growth is for the economy. That said, the manufacturing sector has been hurt by elevated rates, and we've seen a cyclical slowdown in a lot of parts of rate-sensitive aspects of the economy. We might see that for the next quarter or so, but now that rates have come down, we should start to see a rebound in the manufacturing sector. I wouldn't necessarily anticipate that in Q3. I think Q4 and heading into next year, especially as we get certainty from a political perspective, I think there might be, and they mentioned this in the report yesterday, there might be some hesitation to invest just because we don't know what the political landscape will be, especially from a tax perspective. But our base case is Q4 into Q1, you'll start to see a rebound in the manufacturing sector, and the cyclical parts of the economy will start to pick up.
So basically, are parts of the economy just on hold until after November 5th?
I think that's fair. Well, at least on the cyclical side, on the business investment side. There have been some questions about whether the consumers are waiting to see the result of the election. I don't think so. I think the consumer, and we certainly saw that with Q2 GDP, the consumer is continuing to spend in real terms. Certainly goods spending has picked up a little bit. Services spending has been fairly solid, albeit a little slower. But I think it's fair to say on the capital spending side, there are a lot of companies that are just in hold mode. And then once they see the results of the election, realistically, probably either way, they'll be able to start investing again. And they'll have a greater sense in terms of what the investing landscape will be next year.
Stephanie, we've got to leave it there. It's good to have you back. The brilliant Stephanie Roth of Wolfe Research on the latest on the jobs market, looking ahead to Friday. table, Amanda Lynam of BlackRock. Amanda, good morning to you. It's good to see you.
Thank you for having me.
Let's get to this credit market. How sensitive has this credit market been to the growth scare of the last 4 weeks?
It's been incredibly sensitive, and I think you can see it both in the widening that happened during the early part of August and the very swift snap back. And I think what that shows you is that the credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment. Starting trading yesterday morning, we had retraced the entirety of the early August widening. We saw almost a record day of new issue supply yesterday in the corporate credit market, so spreads have gapped out a little bit wider than that, but we're still in this kind of narrow range. We're seeing widening get bought by investors. I think the key for credit investors is that, one, yes, the forward path of monetary policy matters, but the reasons behind that rate cut really matter. And then two, we don't need really strong growth in credit to remain resilient. We just need trend or slightly above trend. And I think there's really a wide chasm between a recessionary outcome and the current pace of above trend or slightly above trend growth. And we live in that space in between.
You noted the recent round trip. How symmetrical was the widening versus the tightening beneath the surface? What led and what lagged?
So actually, a kind of higher beta cyclical sectors led the tightening, but it wasn't uniform. For example, triple Cs are still underperforming the overall broader index tightening. But this has been almost a low quality rally in that high yield and leveraged loans have been outperforming their investment grade peers over the past few months. That's continued the year-to-date trend. And so for all of the talk about concerns about downside risks, I think investors are making the calculus that are saying, okay, I'm entering at pretty attractive all-in yields. Growth is slowing, but it's not slow. And therefore, the outcome for corporate credit investors can be quite resilient in that backdrop.
What are you personally advocating for?
Yeah, so I think there have been a couple asset allocation shifts that have been super relevant. The first and foremost has been the trade-off between high yield and leveraged loans. For most of this year, that equation was very clearly in favor of leveraged loans because of the rate backdrop. I think it's now shifted more neutral between high yield and leveraged loans. That's one. Two, the recent volatility has showed us how quickly the market can change. That's especially true for the borrowers that may have found that they were locked out of the market even just for a short period of time. So I think we've seen more interest from investors on kind of private capital, something that's not at the whim of the public market volatility. And then three, I still like moving down in quality within the investment grade spectrum. I think one of the key developments since the pandemic is that cliff between downgraded from IG to high yield isn't as severe as maybe we would have thought several months ago. And so if you can own BBB rated firms that have a strong incentive to stay investment grade, and even if they do fall to high yield, will likely be supported and bought, I actually like that. So I think within IG, moving down in quality makes a lot of sense. Within high yield, I would not go all the way down in quality to that triple C cohort because they've lagged.
When you say the corporate credit reaction to the cuts is more important, aka normalization or easing, because they're actually seeing the deterioration in the economy, that scenario is not reflected right now in valuations. What would it take for that scenario to be reflected?
You're exactly right. I think 316 is where we are on the high yield index. That's nowhere near even the post-financial crisis average. So what we are baking in at the moment is truly a pretty benign outcome for credit. I think, as Stephanie mentioned, you would need to see deterioration in the labor market, the growth backdrop that is consistent with the weakness that we saw in July, such that it kind of spooks credit investors that growth is not even at trend, but actually meaningfully below. That's really the critical factor. But again, so long as we have trend growth, companies have shown that they've had an ability to navigate this cost of capital environment. And so really, it's an extreme downside risk to growth. Now, I think the important thing for investors, though, is there is a lot of room for spreads to widen. In such a scenario where we're kind of nearing kind of not recessionary levels, but a sharp slowdown, I think you could see spreads go to 550, 600 from 316. So there's a lot of room to widen.
You've got your finger in the pulse of this market. I think an interesting question for Friday would be how sensitive this market would be to stronger than expected data versus weaker than expected data. What would generate the larger move?
I think weaker than expected data because it feels to me like stronger than expected data is almost priced in at the moment. I realize that GDP can be revised and third quarter's tracking at 2%. So I would say that's not extremely above trend, but we've had resilient growth all year. And I think the consumer has surprised to the upside in terms of spending, albeit bifurcated.
Just quickly on supply, you mentioned it. the amount of supply we've had in the last 24 hours, the announcement of companies bringing debt to market. Yes. Are they operating from a position of strength or weakness or stress?
A position of proactivity and strength. And Stephanie had mentioned kind of capital spending slowing, but capital management has not slowed. And so companies, I think, are being proactive in terms of capital management and the balance sheet as they move towards later in the year in the event risk.
A clinic, as always. It's good to see you. Thank you. Amanda Lynam of BlackRock with the latest in the credit market. Elsewhere, the Barclays Energy Investor Conference kicking off today in New York. Baker Hughes CEO Lorenzo Simonelli attending following a better than expected earnings report earlier this summer. The company seeing higher demand for its drilling services and equipment in international markets. I'm pleased to say that joining us around the table is Lorenzo. Good morning, sir.
Great to be with you.
Let's talk about the outlook. You raised the midpoint of that outlook. Competitors did not. A similar story with competitors, though, was this better international backdrop compared to, say, what's happening domestically. What explains that divide that's emerging right now?
I think, first of all, as you look at Baker Hughes, the strength of our portfolio is much broader than just oilfield services. And so as you look at the results that we posted in second quarter and also the increase in guidance, it's really based on that total portfolio capability that we have that extends into rotating equipment, compression, and industrial sectors as well. As you look at the international markets, again, they are going to continue to grow. And again, we said at the beginning of the year, we would see high single-digit growth in the international markets. We retain that view as we go into the second half. And as we go into 2025, the growth will still be there. It will decelerate. And it's really driven by the demand that you're seeing internationally. When you look at the exports, for example, from Saudi Arabia, a lot of that goes to other countries. Very little comes into North America or goes into the developed marketplace. It really is a developing market aspect and the growing population. And demand for energy globally is increasing.
Can you talk to us about the headwinds domestically and where they're coming from? Is it off the back of the consolidation we've seen? We've seen more careful spending. Is it off the back of lower prices? What's driving it?
There's definitely a lot of the aspects of consolidation that have taken place. There's efficiency also that you're seeing within the production, which has enabled production to stay relatively flat and increasing in some cases. And so domestically, I think, again, we continue to see weakness as we look at the second half of 2024. And then also in 2025, really looking at North America to be flattish. The gas market may be increasing somewhat. But North America is really the operators being very pragmatic with their balance sheet. And again, capital discipline is the name of the game.
Yeah, you need a lot less capital now to produce even more oil than you had in the past. But you think it's going to be flat. Some of the numbers we've run actually see 13.9 million barrels a day coming from North America and then 14 in 2025. Do you think that's an accurate trajectory?
Again, if you look at between 13.9 and 14, you're looking at a very slight difference. And again, it's driven by the efficiency. It's very transactional in North America. So I think it's early to call right now, and we'll continue to monitor it. Baker Hughes is much more focused on the production side and also the chemical side. And I think what we are seeing is really a focus on existing wells and also improving recovery rates from existing wells. And that's where the mature asset solutions that we provide actually have a huge opportunity. And it's actually important to remember, 70% of the world's production comes from mature wells. And that's a well that's been in operation for over 25 years or has 50% of its reserve depleted. If you're able to increase the reserve recovery by 1%, you're going to add 2 to 3 years of the production required globally. So there's a big focus on capital discipline and maximizing the recovery rates from the mature assets that are available.
You also mentioned gas. Can we talk about liquefied natural gas? Because yesterday we actually saw the Energy Department go ahead with an export license because the Biden moratorium on these export licenses, the courts have pushed back. Is that a sign that potentially we could see more LNG come online?
First of all, very pleased that the license was given, and congratulations to the team there. I think as you look at the global expectations, it's that the moratorium actually ceases in 2025. As you look at the LNG demand, it's expected to increase. We've predicted that by 2030, we need an installed base capacity of 800 million tons per annum, and the US can contribute to that. That being said, you're never sure until it's done. And international projects are continuing to go forward as well. So the LNG will be available, and hopefully the United States also participates, as it's got plenty of gas that it can export.
A big focus on this program over the last, I would say, 6 months or so has been the burden that's going to emerge on the energy grid in this country in the next several years. Every single day we talk about NVIDIA and CapEx spend coming from some major tech players, spending money, throwing money at data centers. Can you walk us through just the scale of demand you're expecting to see and what you're hearing from some of these utility providers and some of these companies, these tech firms, and the need for off-grid solutions that you can provide? How big is that growth opportunity for you?
It is a significant growth opportunity. And I think you said earlier, this isn't just about today, it is a long-term trend. If you look at some of the statistics out there, generative AI, the consumption of electricity by data centers, it's expected to double by 2026. That's going from 2% to 4% of the electricity usage. Think about that. That's the same amount of electricity that Japan uses on an annual basis. So from an installed capacity perspective, it's a significant increase. What do we have as a challenge? Grid stability, and also, I live in Houston. Today I have power outages on a continuous basis. And we need off-grid solutions, and that's where distributed power comes in. That's where opportunities for modular capabilities of gas turbines that are packaged, smaller, off-grid, and they provide the stability to the data centers for ongoing operations. Because the other important aspect is intermittency is important because a data center can't go down. So you need to have that consistency of power generation.
What does growth look like in this area currently, and what will growth look like in the years to come for you exclusively, specifically?
For us, if you look at the industrial gas turbines that we provide, significant opportunity. Just look at the ratio of the increase on the electricity utilization from 2 to 4%. So we're looking and working with the hyperscalers, looking at the ecosystem, and we're looking at the opportunity of mini gas turbines being sold into this marketplace.
What's the overall contribution to your revenue mix do you expect to come from that in the next, say, several years? The reason I ask that question is we've seen a big rally in utility companies in line with the rally we've seen in AI firms. And if we're to sit here today and think about the changing characteristics of your stock, I'd need to know what the contribution from that area would be to the overall top and bottom line. What's that going to look like in years to come?
Yeah, as we look at it, and again, this could be from 500 megawatts to 1.5 gigawatts, and that's what we're looking at from a scaling perspective. And again, from a dollar perspective, it's going to range based on 500 million to potentially larger, and it's going to come over a series of years as we go forward. We look at it as a major new area that we can focus on. We've participated before, and we've played in distributed power generation, and we look at this as a growth vector for Baker Hughes.
A big concern to the U.S. energy industry has always been these cyber attacks, whether that's Colonial, what's recently happened with Halliburton. Have you seen any impact?
So we haven't seen any impact. Again, though, we're very vigilant. Obviously, cybersecurity is a big concern for everybody, and we're all taking the measures accordingly to put the controls in place and very much vigilant on a daily basis.
What does that look like, meaning being vigilant? Is that having the proper systems in place? Is there a lot of communication with the U.S. government?
There's definitely communication that takes place across the sector, and there's also trade associations that discuss it. From a standpoint of vigilance, it means making sure that we're doing our own testing on our own systems, making sure that we're putting in the controls, we're patching with the new security that's available, and also doing our own phishing exercises. And so we've got a team that continuously, red team, blue team, and we test our own systems. But I also say you can never be too careful. And you've got to stay vigilant, and you've got to be prepared.
You've got a really busy day ahead of you. Before we let you go, this conversation's got a time horizon of multiple decades. The time horizon of this market at the moment is about 5 minutes. Can we just reflect on yesterday's price action? What's going on in crude, in energy markets at the moment? Is there a real tangible concern from your side around demand in China? What's it all about?
I think you're always going to have volatility on a daily basis, and it's something we deal with in the business world. At the same time, leading a company, you got to focus on the fundamentals and the fundamentals of the long-term trajectory and make the right investment decisions. That's what we're doing at Baker Hughes. And if you look at the macro tailwinds, I think it's undeniable that energy demand is continuing to increase. As you look at the population and you look at the development of nations, you also look at developed nations that are now seeing that they don't have enough energy as well, such as here in the United States. So we look at the macro aspect, and we're definitely seeing positive tailwinds.
Do you feel like the attitude to fossil fuels has shifted in the last 12 months? Do you think governments, particularly in the West, have had a bit of a reality check?
I think there is an understanding that it's not just about an energy transition, it's also about an energy expansion. And it's not about the fuel type, it's about reducing emissions. And that's where gas plays a key role because it is abundant, it's available, and you need affordable, secure, reliable energy.
Lorenzo, appreciate it. You've got a long day ahead of you. Thanks for your time.
Thank you.
Thank you, sir. Lorenzo Simonelli there, the Baker Hughes CEO. McShane of Goldman Sachs saying the following: we have seen growing concerns around the health of the US consumer and more value-seeking spending behavior. However, our economists continue to see a resilient consumer and believe the concerns around weakness in consumer spending are likely overdone. I'm pleased to say that alongside Kate is Bloomberg's very own Lisa Abramowicz. Lisa, good morning.
Good morning, John. Good morning, AMH. Thank you so much for having me. And frankly, this is really the key question for so many on Wall Street and Main Street. Basically, how resilient is the consumer? And we talk about weakness. At what point are we talking about actual weakness versus just it's getting competitive out there? Kate McShane joining us here. Kate, thank you so much for being with us. I am curious, how much weakness is there? Do you give credence to this story that the consumer is fragile?
Yes. So good morning. Thanks for having us. I think when it comes to the consumer, what we continue to see is a somewhat steady consumer. I think what we've heard from most of the companies that we cover is that not much has changed with the consumer over the last 6 months. They're employed, wages are growing, but they are being choiceful. And part of the reason why they're being choiceful is because there has been a lot of inflation over the last couple of years. Their money doesn't go quite as far. So you are seeing choices between consumables and discretionary. You're seeing choices between services and goods. And I think that's what's differentiating maybe some of the different performances that you're seeing out of retail coming out of the second quarter.
So how do you square this idea that we keep hearing this, and yet margins are expanding?
Yes. Well, there is some growth, so there is some leverage in some of these retailers' models, but at the same time, you've seen costs dissipate, especially on the freight side of things. And so there has been some improvement in margins as costs have come down on freight.
Okay, so it's more of that story and not so much that AI is creating this incredible efficiency that's overwhelming any potential price losses and pricing power that they're losing.
Not yet. I mean, we are starting to hear more, of course, about AI, just like we are across all the other industries, but it's much more nascent and more about efficiencies with regards to getting more efficient with how they catalog online with their e-commerce and maybe freeing up some tasking for their labor. But there isn't anything of scale yet that we've seen that is revolutionizing, what's happening with margins in retail.
So just to be clear, when people say maybe some of the increased productivity that we're seeing that's leading to these higher margins stems from the idea of AI making inroads, not really seeing that quite yet.
I don't believe so. Again, it's being talked about, but I don't think it's being touted necessarily as one of the bigger drivers of why margins are better year over year.
When people talk about a more choiceful consumer or a more discretionary, how much are they talking about just a sort of stagnant pool and greater competition to get that pool? And I'm thinking about higher income individuals. And increasingly, the holy grail has been just to get a chunk of that.
Yes. Well, they are speaking about the higher income individuals too with the choiceful consumer. And I think it's maybe less about consumables versus goods or consumables versus discretionary, but it's that services versus goods. Part of what we saw during the pandemic was a really heightened demand for goods, things, apparel, home goods, things like that, consumer electronics. And then as soon as the world opened up, you went back to services. We haven't quite seen that pivot back to discretionary goods. It was only on Target and Walmart's conference calls that they have just seen some stabilization in goods. So it's that choicefulness that's happening at the higher end as well because they're choosing between services and goods.
So you've been doing this a very long time. You've been at Goldman Sachs 6 years. Before that, you were at Citigroup and Credit Suisse, and this has been a conference that's been going on for 31 years. How is this time different? in terms of just the tenor of certainty or lack thereof in terms of the economic cycle, as well as the interest rate cycle, as well as some of the technological overlays that you're seeing?
Yes. So the cyclicality is always the name of the game, right? Year to year, we're going to be in different cycles. And so certainly right now we're discussing about, the health of the consumer because of the interest rate environment we're in, because of what's happened over the last 5 years. But I think what's so different about the conference this year and what companies are going to be talking about is we are entering year 5 post-COVID. And most of the companies here had benefited in a significant way during COVID when everyone was shut in and needed to be entertained or needed to buy food. And now we should be entering a period in 2025 where it's more normal for consumer behavior. And so we're going to be focused on asking, in addition to the macro and what the expectation is for the health of the consumer, what their behavior looks like in 2025.
What are you seeing? What's the answer to that?
So we're still seeing that choiceful consumer, but as I mentioned with Walmart and Target, they are starting to see some stabilization in discretionary goods. And so our thought is that you will see more normalization of the consumer balancing the choices between goods and consumables and services.
How much do you see the most powerful companies consolidating their market share in a way that we haven't really seen in the past? And I'm thinking of Walmart, I'm thinking of Amazon, I'm thinking of some of the behemoths.
Yes. We do think that that is an element that's happening across retail too, the haves and almost the have-nots. And part of the phenomenon is that the scale and the one-stop shopping is really appealing to the consumer. So if we take Walmart as an example, it's not just the value that they're offering the consumer, the discounted prices, the rollbacks, but it's the convenience. It's the fulfillment optionality that you can get with delivery or click and collect or buy online and pick up in store.
What do you think is the biggest anxiety at this conference for the 80-some companies and executives that are here?
I do think it's figuring out the consumer. That's probably one. I would say tariffs is another. That's a big question mark as to what that looks like post the election, and it could be very costly, and retailers are going to have to figure out what they do with their pricing as a result of that.
Kate McShane, thank you so much for being with us. Thank you for having us here. That was Kate McShane, U.S. retailing analyst at Goldman Sachs, here at the Goldman Sachs Retailing Conference.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.